Good morning, everyone. Eric Walters, Managing Partner at Summit Hill Wealth Management. We will get started in just a second. I can see participants are kind of loading in. So if you'll bear with us, we will get started in just a minute. Okay, looks like that's good. So again, everyone, welcome. My name is Eric Walters, Managing Partner at Summit Hill Wealth Management. At our work, we help business owners and executives protect and grow wealth through financial planning and portfolio management. Thanks for joining us today. We're going to talk about how the recent market volatility has impacted the valuation of private companies and what business owners can do to kind of maintain and increase the value of the business. We would welcome your questions. So on the bottom bar, there'll be a Q&A or a chat button. Feel free to type in questions as they come up. If we don't catch them while Brett and I are talking, we will catch them at the end of our discussion. And we'll also have a recording of this session available. So I'm thrilled to be joined by my friend, Brett Story. He's a founding partner of Britehorn Partners. Britehorn is a leading middle market investment bank led by an experienced team that advises businesses across the U.S. Britehorn tends to work with CEOs of established companies, often 20 years or older. And in their kind of history, many of those companies have average revenue of 26 million per year, and their transactions are averaging about 43 million average transaction value. And then looking back, about 50% of their transactions recently have been sold to private equity, 33% to a strategic buyer, and 17% sold to another financial buyer. So Brett and his team have significant experience with successful middle market companies. Brett is an experienced investment banker. He has extensive transaction advisory experience. What I think is unique about Brett is that he has also practiced corporate law, both in Denver and Miami, and holds a JD from the University of Miami. So Brett, pleasure to have you join us.
Excited to be here, Eric. Looking forward to this.
Hey, thank you. So, Brett, if you could maybe, before we start talking about the current market, and dealing with volatility, maybe we can back up, just a step, and maybe you can give us an overview of what merger and acquisition or M&A activity was like for middle market companies coming out of COVID, late 2020 and into 2021. Maybe you can give us context of what it was like, kind of most recently.
Well, nobody saw that coming, for sure. And I think it was very industry specific. Obviously, there were a number of industries that were devastated and hit very hard by the pandemic. And our hearts go out to those business owners whose companies really suffered. On the other side of the coin, there were, a number of industries that really did well. For example, we've done a lot of work in financials and insurance, and in particular, real estate title insurance, which was going gangbusters in 20 and 21 on the back of historically cheap interest rates, demographic changes around home builders coming into or home buyers coming into their prime buying years, as well as geographic relocation. And so it was really a mixed bag, and a lot of businesses achieved historic transaction valuations in 20 and 21.
Yeah, that was exactly my impression as well. And I think you said it really well. And you said it's really industry specific. You talked to some business owners in the middle and end of 2021 saying still recovering, had a hard time opening their doors, hard time finding people, struggling to stay afloat. Others, I think, would kind of look around and say, we've had the best year ever. And the offers we're getting from buyers to purchase us are numbers we've never seen before. And that kind of dichotomy, I'm sure, has existed in prior recessions and recoveries, but it was pretty extreme at the end of 2020 and 2021.
Yeah, I'd agree. And whenever you've got a combination of historically cheap debt, which is in almost every instance, save for rare exceptions, used to fund acquisitions, plus trillions of dollars of capital sitting on the sidelines, both with private equity and with strategic buyers that had been in essentially a 10-year bull market. That's going to, just by basic supply and demand dynamics, drive up valuations.
Yeah, definitely. So that was, coming out of COVID 2020, 2021, a lot of enthusiasm, a lot of great valuations, a lot of great transactions for some industries, not all. Now, this year, it's changed quite a lot, right? We've got high inflation that started at the end of 2021, of course, the war in Ukraine, and then the Federal Reserve is dealing with the higher inflation by raising interest rates. You have the stock market has, dealt with that by, experiencing some notable declines. It looked like we were recovering there in kind of August. We may still be struggling with inflation. So now maybe give us kind of a flavor of how things are happening in the M&A market right now, both in terms of valuations and other trends that you're seeing in terms of deal flow.
So, one of the things that's interesting about the lower middle market where we play, and I would just sort of say sub 100 million revenue businesses, is it's not really correlated to the S&P or NASDAQ. We've actually not seen much depression in terms of top line valuation. But what we have seen is, from a structure standpoint, a demand by buyers that more of the deal consideration is carried forward. So when you think about a deal, there's really two components. There's the cash at closing, and then there's whatever consideration is on the back end. And that can come in the form of carried equity, an earnout, which is tied to revenue or profitability or some other metric, or a seller note, where essentially the seller is acting as a junior lender to the buyer. And because of the volatility, because of high interest rates, which essentially raises the bar for most buyers in terms of their return on the investment, they're seeking deals with more alignment on the back end, and say in 20 and 21, where most of our deals were 75-80% cash at closing, that's now more 55, 60, 65% cash at closing. So that's been the biggest change. There's still a high demand by buyers for good companies. Everyone understands that we're in a different phase of the business cycle, and most buyers have at least a 5 to 7 year time horizon, and are willing to accept a flat revenue year or slightly down to acquire a quality business that they're willing to see and excited to see perform in the future. But they're shifting the risk to more on the back end.
Makes a lot of sense. Now, we would be remiss if we didn't talk about the impact of private equity. Traditionally, private equity dealt with usually larger companies, but what I've observed is that private equity is very interested in profitable middle market companies. So I wonder if you could just talk about the impact on private equity in the market, and how that's maybe changing things right now.
Yeah, I mean, private equity is a massive driver of activity in the lower middle market. Most of them will have a sort of threshold level of profitability for buying a platform business. And by that, I mean the sort of first foray into a specific industry. But then whenever they make a platform acquisition, they'll make what are called add-on or tuck-in acquisitions to grow the platform. And there's really no limit to the profitability level or revenue size. And so I'll give the example again of the title industry. Traditionally, in the title industry, the title agencies would sell to the large underwriters. These are publicly traded companies like Fidelity and Stewart and First American. Well, suddenly private equity woke up to the industry. Other strategic buyers like Zillow and Redfin have entered the industry, and that's happened across many different industry verticals, where private equity gets involved and really raises the level of competition for quality deals, which, if you're a seller, is exactly the place you want to be in.
Yeah. I wonder if you could elaborate a little bit more on the current market and how private equity firms are looking at companies. I think maybe the curbside view of some people would say, look, we're worried about recession, higher interest rates. I'm sure deal terms are terrible, and I'm sure volumes are terrible. But my impression is that with the amount of money that is committed to private equity, if some owners are maybe stepping aside saying, we're concerned about our business, or we're going to wait until a better time, that money still is looking for good companies. And so I wonder if you could elaborate, how is private equity looking at companies right now? Are there particular industries like the title industry you can think of where things are actually looking pretty good, despite what you may read in headlines?
Well, to answer the first part, I mean, you're exactly right. There's still trillions of dollars of dry powder. And remember, the private equity model is that they guarantee their investors a certain hurdle rate of return. And the owners of the private equity firm don't make money until that hurdle rate is achieved. And they're certainly not going to make money sitting on cash. So there is continued demand for good companies. As I mentioned previously, the structure of deals is changing, but we haven't seen a ton of depression of top line valuations. And there are a lot of industries that are still doing well. Certainly industries that are commodity exposed or interest rate exposed or real estate exposed have suffered a bit, but it hasn't resulted in any sort of cratering or lack of demand in the market, because again, these private equity buyers are not buying a company with the intention of flipping it in 1 year. They're thinking 5 to 7 years out. And the advice that we always give to sellers is, look, you can try and time the top of the market or the bottom of the market. It's very difficult to do. And it's also, very difficult to anticipate the sorts of things that can impact your business's valuation, like losing your biggest customer or an employee lawsuit or, God forbid, sickness or death among one of your key staff people. And so the guidepost that we often offer is, unless you're really committed to continuing to run your business for 5 years, if you've been doing well, it's really an interesting time and an appropriate time to at least evaluate your options in terms of the sale, because none of us can really predict the future.
I can't agree with you more. I have heard that so many times where owners have said, we've done really, really well. And we're at a certain level of revenue or valuation. And if we could just get, and then they'll fill in the blank. If we could just get 30% more, if we could just grow more. And they'll often say, well, based on current revenue, based on our projections, we think we'll be there in 18 months or 24 months. And the challenge is, you never know when a 2008 or a 2020 is going to be around the corner. And that 18 months or 24 months could then become 7 years or 8 years to get back to that level where you're at right now. And so I always ask owners, similar to your question, are you ready to go through a whole nother economic cycle? Right? Deal with the downturn, maybe cut people, rebuild your business, and get back to this point. We don't know when that's going to happen. And that's to your point. Look at your options now and don't take the future for granted, and try to avoid timing.
Yeah, I mean, the trend is your friend, because if you suffer a 30% decline in revenue, for example, and then work your way back to where you were the next couple of years, you're not going to get the same valuation as if you had sold prior to the decline, because they're going to take that serious decline into account. And that's where working with someone like you is so important in crystallizing for a seller, what do I need? What do I need to enjoy the lifestyle after tax that I've worked so hard these so many years to achieve? And oftentimes they'll find that the number is not as high as they think, and very achievable in the market if they get good advice from an experienced advisor, investment bank that is active in the market and routinely selling businesses, versus picking a valuation out of something that they read or another source.
Yeah. And that's been my experience in our work with business owners. That's the first thing we do, is try to answer that question. How much do I need to enjoy my lifestyle, even assuming maybe the stock market doesn't return the returns it has in the future, or maybe tax rates are higher, or maybe inflation is higher. Even if these headwinds are in place, how much money do we need? And I think you're exactly right. Often the number is lower than maybe the current valuation or the hope for valuation. And that can provide some real peace of mind. I mentioned that I was talking with the owner of a business the other week, and it's a solid business. They're making 50, 60 million, then approached by multiple potential buyers recently. And, they were entertaining some, what I'll call kind of casual offers, or, kind of casual letters of intent, or LOIs. And they're kind of saying, hey, given where things are, maybe we should hold off. Maybe we should try to squeeze an extra whatever out of the deal. So they're kind of waffling. We don't know. Should we do now? We've been growing like a lot, or should we wait? How would you approach an owner like that? I'm sure you have questions like this all the time. We feel we're doing well. We'd like to push for more. What should we do?
Well, what I can say about the sale process is as much as we'd like to work with that client, we wouldn't, because they've got to be very clear about their objectives and what they want. The M&A process is a 9 month ordeal. It certainly, we've done deals faster than that, but it is an intense process. It's labor intensive, it's stressful. All of the human emotions come to bear: fear, greed, all of those things. And so you've really got to be clear in your own mind as a seller. What am I trying to achieve? What is the outcome I desire? These are the 10 things that really matter to me. And our job is to deliver a deal that gets 7 or 8 of those things, and find the right buyer partner that can help achieve your objectives. So there's a lot of soul searching that should happen at the very beginning, and that's part of the process that we do in working with a prospective seller. Is, what are you trying to achieve? Why are you selling? Why now? What are you going to do with your life? Assuming you exit the business. Obviously, there are plenty of transactions where a seller will sell a majority interest but continue going and operating the company. But for those sellers that are going to ultimately step away from the business, what's next? Is it charitable work? Are you going to travel the world? Are you going to play golf every day? Whatever it is, you need to have an answer to that, because when confronted with this kind of uncertain future, it can be difficult to pull the trigger, because for so many of these business owners, this business is such an integral part of their identity.
Absolutely. And it goes back to what we were talking about. I think if you can identify your number to walk away and kind of really experience financial independence, part of that is spinning out the future of what you'd like your life to be. And I think that goes to legacy. What do you want to be remembered for? What relationships are most important to you? And then how will you use all the talents that you've developed? For some people, it's volunteering, other it's certain hobbies. But you're right, you have to have kind of a vision of post-transaction pretty firmly embedded in your mind, or when the turbulence happens during the M&A process, you're more likely than not to say, I don't want to go forward. This isn't going to work.
Yeah, and it's seeing for the forest for the trees, because there's ego that gets involved, and there's minor deal points that get negotiated between lawyers that seem like the most important thing in the world, but being able to step back and say, hey, look, this is what I'm trying to achieve, and I may have to give on this point and take on that point. And then even the other deals where it's for example, we sold a business in Philadelphia, young founder is 43 years old, and he has a young family, and his whole net worth was this business. And I'm sure you've had clients like this as well. And his analysis was, look, this business is doing really well, and I can see my wealth on paper growing, but what if? And so the right deal for him was selling 60% of the business, putting a significant, almost generationally transforming level of wealth aside. He knew his family and kids and probably grandkids would be taken care of. College was paid for, and it really de-stressed him and de-risked him to allow him to keep going. And he's going to get a second bite at the apple because he still retains, say, 35% of business.
Yeah.
But it's really all upside from there.
Yeah. It's interesting you mentioned that. We were talking before the webinar started. I wonder if you can elaborate a little bit more about business owners where the business is doing well. They've got options. They can keep running it. They could consider selling some or all of it now, but they'd like to continue running it, but they've got maybe a need for capital, or they'd like a partner that's strategic. I'm seeing more and more sellers interested in selling a minority of their business to take some money off the table and gain a partner. Not just a capital partner, but gain some sort of partner. So could you talk about options for businesses that maybe are looking for equity or looking for a strategic partner, whether that's debt or a minority equity interest? What are you seeing, and could you go over some of the pros and cons of those options?
Yeah, certainly with debt, it's straightforward. The lender is going to do an analysis on your cash flow, or in some types of businesses, inventory, assets, receivables. And you just want to be very clear about, why am I borrowing this money, and what's it going to be used for? And oftentimes it's a better option, say, to hire people or to open a new office. to facilitate growth than taking on an equity partner. An equity partner, a minority equity partner, can be important for a couple of reasons. One is offering that, say, operational acumen, or there are plenty of private equity firms that are interested in taking a minority interest, and perhaps they've got portfolio businesses and other relationships that would allow you to cross-sell or collaborate or improve your supply chain. So there are folks that just write checks, and then there are folks that bring a lot more to the table than just writing a check. Now, understanding, of course, the devil you know can be better than the devil you don't, and you're going to want to make sure that the private equity firm or investor that's coming in shares your values, shares your vision, that you're aligned in terms of objectives and outcomes and timelines. But that can all be a very effective way of either adding growth capital to a business, or in some cases, perhaps there are a couple of partners where one is significantly older, not involved in the business, and is looking to be bought out. And that's a way of achieving that without giving up majority control of the business.
And I was interested in something you just shared there, encouraging owners to think carefully that a minority equity partner shares their values. Can you elaborate a little bit more about how you help owners select amongst multiple buyers, whether that's a minority interest or majority interest? How do you get to that point to say this would be a good match, not only for me in terms of the deal terms if I'm the owner, but also for the company, for my customers, for my employees? I hear that a lot. Employers will say, these people have been with me. I want to make sure they're taken care of. How do you help sellers navigate potential multiple buyers from a fit standpoint?
Yeah, it starts with really extensive work at the front end and getting to know the seller, what's important to them, and ticking the boxes of those values that are sort of non-negotiable. Then we get to work, and exactly what we do is bring options to the table based on our relationships and experience, and identifying the right types of buyers. And then there's really a mutual interview process. Once a buyer is in the ballpark on valuation and structure and some of those more mechanical things, it's about getting to know each other, understanding, is this somebody who's going to check in once a quarter at the board level, or is this buyer going to be involved in the day-to-day operations? And maybe that's what the seller wants and needs. And so, we encourage sellers to speak with current portfolio businesses of, for example, a private equity firm or companies that they've worked with in the past. It really is a mutual interview, and we take our time with that to make sure that it is the right fit. And we sold a company last year in Indianapolis, and the owner was adamant that, look, I've put or helped put some of my employees through college and their kids through college, and this is a family, and this company was 80 years old. And we found a buyer under what's called an independent sponsor or search fund model, where it was an executive that was experienced in the industry. He had backing by an equity investor, a group of investors, and he really came in and kept the culture status quo, kept the business status quo. He just stepped in to replace a CEO who was ready to retire. And that was a much better outcome and a much better fit than had we sold that business to a strategic in the industry or say a traditional private equity firm.
That's really helpful. And, in that scenario, that reminds me of, another option for owners, which is an internal transition, to, employees, maybe executives. Could you briefly touch on when that structure is kind of most helpful, or are there particular industries where that kind of internal succession may work best for certain businesses?
Yeah, I mean, I think what you're referring to is something like an ESOP, which is an employee stock ownership plan. And essentially the way that works is the company borrows money from a bank. That money is used to, over time, cash out the previous owner or owners. And when that is done and the loan is more or less repaid, a trust that comprises the employees of the business then becomes the owner of the business. And And this has worked. It can work. It tends to work more in asset heavy industries because the amount that a bank will lend a business is going to be tied to assets and inventory or cash flows. And a general services businesses that may be asset light, but people heavy, relationship heavy, is just not going to get the same valuation from just borrowing at, say, 3 times cash flow that they would in selling the business for, say, 6 or 7 times cash flow. So it can be an attractive option. Tends to be for maybe smaller businesses, I'd say sub 3 or 4 million of net profit, but it can work.
And if a company has implemented an employee stock option plan or an ESOP, does that affect its ability to then be sold to another company?
It may make a transaction a bit more complex. For example, if a company is owned by, say, 50 employees, there's going to be issues like, what percentage of those employees needs to agree to a future sale? Is it 50%? Is it 75% super majority or something like that? But generally speaking, it's going to kind of be the same process. You're just, forgive the term, herding more cats than you would if it was a company with, say, 3 shareholders.
Sure, that makes sense. Now, I'm curious if you could give advice for a business owner that says, I'm not interested in selling right now. 3 to 5 years is a time frame I frequently hear. What advice would you give them about how to grow and build their company to improve the value between now and whatever point in the future they're thinking about selling?
Nearly every deal I've ever done is driven by people. At the end of the day, that's what buyers are buying. Customer relationships matter, intellectual property or products matter, but without the right team, the valuation is never going to be what it can be. And so if you're a seller who is thinking of, say, taking some chips off the table but continuing to go, you want to make sure you're surrounding yourself with the best people possible, which is not easy in this environment, and is something that has been a challenge for businesses, finding and retaining talent. And you can do that by making sure everyone is aligned in the upside via stock options or a phantom equity plan or some sort of incentive that, yes, when I sell this business, you're going to participate as well. To the extent you can untether the business and certainly customer relationships from just one person, that will de-risk a transaction in terms of if that person leaves or whatever else, that those relationships aren't going to leave with them. And then there's basic stuff, making sure your books are in order, you're paying your taxes, you're working with legal counsel to make sure the company's structured right, the important agreements are papered up, all of those things. And the last thing I'd probably touch on is customer concentration. You never want a customer to be, more than 10%. There are exceptions to that, certainly if you're just serving a specific niche industry and the customer relationship's really sticky, that won't necessarily be a detriment, but as a rule of thumb, a broad and diverse customer base is important.
Sure. Yeah. And I've heard, that owners should not underestimate the power of simple things like just being really clear on people's roles, responsibilities, documenting procedures. A lot of people say, Beth in accounting, she just handles it. But if Beth were to, be out for a couple of months, people don't know exactly what she does, and just documenting her work. It's not to, put Beth's job at risk, but just to systematize things. So I've heard, and this is, it seems simple, but it can be hard to be clear on what's the role, what's the, what are the procedures. And then I've also heard feedback from, clients that just having a written plan for growth and a written plan for how they go to market and marketing makes a difference. That the owner basically says, wow, I can see the people, I can see their roles, I can see how they operate, and I see your plan. That makes a big difference in whether we're interested in this business.
Yeah, I mean, the same thing that drives entrepreneurs to achieve and succeed and build great businesses can also hold them back in terms of ego and not being willing to delegate and wanting to wear too many different hats, and that can work to a point. But there's some humility and self-awareness that comes into play in terms of what am I really good at, what am I not good at. For this business to go from 10 million in revenue to 100 million in revenue, what has to happen? And those are all the questions that come into play when you're contemplating a sale, because nobody buys a business to just have it be stagnant, right? The impetus is growth, and how do we achieve that growth?
Yeah. So are there, tools or resources that you think owners could consider checking out that are interested in implementing this, but maybe would love to hear from others about how to grow their team, how to put procedures in place, how to find the right people in the right roles? Well, anything you'd recommend?
Yeah, I've had a number of clients swear by something like entrepreneurial operating system, EOS, which is a standardized system for organizing your business and helping grow. Certain things like peer groups, Vistage, YPO, entrepreneur organization. Those are all tremendously valuable. I've been involved with entrepreneur organization myself, and found being able to learn from other business owners who had been there and done it, and being able to bounce ideas and problems off of a peer group is very valuable, because a business owner can feel it can be a little bit lonely at times, and there are often not enough outlets to be able to talk about some of the things that business owners face, because they tend to take so much on their shoulders, and your spouse or partner can only take so much complaining, or can only sometimes relate so much in terms of what you're going through, and same with your best friend or your brother, whatever it is. Finding a peer group that can share in that experience is great. And then two books that I have really enjoyed were Taking Point by Brent Gleason, which is he's a former Navy SEAL. He's books about building and managing elite teams, back to my point about how much of people matter in a company and in a deal. And the other one is by Ryan Holiday. It's called Ego is the Enemy. And it's about how, you can't control a lot of what happens outside, but you can control how you react and respond to it. And that ego can sometimes be an impediment and throw up roadblocks, certainly for a lot of entrepreneurs who have a right to be proud and feel good about a business they've built, but sometimes keeping that in check is important.
Yeah, I love that. I've heard amazing things about Entrepreneur Operating System, or EOS, as well. And in my experience, I think if you're an owner and you are consistently working more hours than you think, or you are kind of blindsided by data in your business that you didn't know about, all of a sudden there's a cash flow emergency, or there's a huge tax bill, or you've got squabbles between people and departments, or you're not on the same page. In my experience, those are all indications that you could really benefit from a good coach or a good consultant or a good system like EOS to help you. I hear a lot about it from owners who say, I can't keep working these hours. On weekends, I miss my kids, events. This is, kind of putting a strain on my relationships. I can't keep doing this. And I think those are kind of warning signs I've seen that you probably have some work to do. Because if you're stressed, if you're working 60 hours a week, if you're working 7 days a week, or if you've got squabbles within departments, a buyer is not going to be very excited about that situation. No one wants to buy a business where they have to work 60 hours a week. They don't want squabbling departments, or, a kind of an egocentric, leader. So kind of dealing with some of those issues ahead of time, I've seen, can be the difference between whether the business is sellable or if you're going to get the valuation that you'd like.
Yeah, absolutely. Couldn't agree more.
Yeah. So transitioning to kind of a personal view, how important is it to a business owner to have a team of advisors around them personally? Think about like an accountant, someone like yourself, just to advise them around, here are some issues that you should be aware of before you sell and to prepare for a sale. So maybe you can talk about what you've seen work well when owners surround themselves with good advisors.
Yeah, I mean, when I was in law school, there was a saying that, a smart lawyer never represents him or herself. And it's a little bit the same in this process. I mean, I can't stress enough how many times that we've seen business owners who went at it alone, decided for whatever reason they didn't need to avail themselves of advisors, and a couple things can happen. One, you can waste a lot of time and effort with the buyer who is just kicking tires, who was never serious, or worse, was more sinister and trying to understand your secret sauce or disrupt your customer relationships. And then you've taken your eye off the ball. The business's revenues and profitability have suffered, and you haven't done a deal. Or there are other cases where you're, quick to grab the first offer that comes around and just simply availing yourself of advisors. Statistics show time and time again will improve those offers. So, you're good at running your business. You're good at growing your company. Have legal counsel who is an expert at what they do. Have a wealth management professional that can help you clarify and crystallize what your life's going to look like after the transaction, how much money you're going to need to live your lifestyle. And whether it's us or somebody else, work with an experienced investment bank that has a full perspective of the buyer universe, can get buyers to be serious, can hold them to timelines and deadlines, can play buyers off of each other to maximize value in terms. It's really, really vital that if a business owner is serious, that they surround themselves with a team to help them execute. Yeah. And whatever you'll pay in fees is a drop in the bucket compared to the valuation and certainty of close that you'll achieve.
Yeah, and I've seen, the exact same dynamic. Owners that represent themselves often are surprised through the due diligence process how far that initial dollar amount will fall if they're not well represented, if they don't have their books in order, if they're not negotiating well, if there aren't other parties, kind of playing off each other. So I encourage my business owner clients to talk with someone like yourself, years before they're thinking about it, just to get a market-based valuation on their business, and then get this advice. You're head of sales. You shouldn't be head of sales if you want to sell the business, or your books aren't put together in a way that a buyer would be interested in. So yeah, right. I've seen the same thing. So I've got one more question, and I'll pause and just encourage our attendees, if you are thinking about any questions, feel free to go ahead and share those, type those in. We'd love to see them. I'll ask Brett one more question, and we'll turn to see if there's any questions. But Brett, maybe wrap up and just share some of the most common mistakes that you've seen business owners make as they're going into a transaction. I mean, you've mentioned one already, representing yourself, but maybe you can elaborate on some, potholes to avoid.
Certainly, not having their books and legal due diligence in order prior to beginning the process, because there's no walking back that skeleton in the closet that is discovered by a buyer, but there's a way to manage it if you know about it on the front end and can control the messaging, because once there's that demerit, you're going to see valuation get hammered. And that's just the nature of the buyer's universe. Having a realistic understanding of valuation and structure, which is again, availing yourself of the advice of somebody who's actually in the market selling businesses. I mean, you can go and get a 409A or a valuation done for tax purposes, and there's a variety of methodologies that are common, but the private markets, and especially the lower middle market, is not as transparent as looking at the NASDAQ and saying, okay, these telecom businesses are trading at this multiple of earnings. It's just, it's not nearly as standardized. The information is not nearly as easy to come by. And so you want somebody who's actually doing deals to give you their realistic perspective of not only valuation range, but structure and some of the things that may impact positively and negatively on valuation. So those are sort of the two more mechanical things, and then the last is being very clear about why you're doing this. Not having that in mind, not being on board with what it's going to take to get there. A deal's never going to get done, because that will come out in the process that a seller's not serious, or a seller's got a lack of vision for where this business can grow in the future, which is exactly what buyers are interested in buying.
Yeah. I think that that's really well said. The two that I'd say I've seen is not being clear on your own personal number and attaching, kind of your personal financial future to a number that you have in mind. Meaning, I think the company's worth 20 million. I won't accept a dollar less than 20. My analysis may show you need 6. And so get into that kind of rigidity. And then, you mentioned it before, but not having your books in order, I've seen really be a serious demerit, because I think if a buyer can't trust the numbers, they start to back away quite a lot. So I've seen that really affect valuations.
Yeah, I mean, to dovetail with that last point just quickly is so many of these deals that contain an earnout where you're going to get some future consideration based on revenue and profitability. Well, those earnouts are almost always tied to projections that we develop with our clients, and we challenge them to be realistic. We challenge them to be a bit conservative, because the last thing you want to do is put out pie in the sky projections. Say a seller said, fine, if you hit those, I'll give you another 10 million bucks over 3 years, but there's no chance you get there. And you have to be very realistic about, revenues don't just grow without costs growing, simple stuff like that. And working with an accountant and an investment bank that can make sure that those numbers are realistic and give you the best chance to hit the earnout if that's part of the deal structure.
Well said. Well said. So, Brett, I think we can wrap up. I'm not seeing any questions right now. I think I've got some ahead of time that I shared already with you. But what's a good way for people to connect with you if they want to have a conversation and just, learn more about your process?
Yeah, easiest way is email me. It's Brett, BRETT, at Britehorn, BRITEHORN.com. I'm also on LinkedIn. Happy to have a very low-key, non-pressure discussion with anybody about what the market looks like from a macro perspective, what we're seeing in specific industries, back of the napkin valuation. Always enjoy those conversations. It's why I got into this business. It's energizing and exciting for me to meet with business owners and learn about all the different great companies and all the different ways people are making money. And so happy to have those conversations.
That's great. That's great. Well, again, for attendees, we will have a recording available. If you have a friend you think would be interested, we'll be happy to share that and we'll get that out. Brett, I want to thank you again for taking time, just pearls of wisdom that you're dropping for business owners. I know I can think of a few owners I think would have wished they would have talked to you before they got themselves maybe a little sideways in something. So thank you for this great advice, and I appreciate everyone's time. So thank you.
Thanks again for having me. Take care.
Yeah, thank you.